You are listening to C-Suite Perspectives, a podcast by the Conference Board.
Welcome to C-Suite Perspectives, a signature series by the Conference Board. I'm Sara Murray, Managing Director International and the guest host of today's episode. Today we'll discuss the economic and business impact of the ongoing conflict in the Middle East and what it means for Europe and global markets. Joining me is Alejandro Fiorito, economist at the Conference Board Europe, who will help us unpack the latest developments, how markets and companies are responding, and what this could mean for the longer-term outlook. Welcome, Alejandro.
Thanks for having me, Sara.
So let's dive straight in. How have markets evolved since the conflict started?
So they've swung pretty wildly, to put it bluntly. We had in a single day the highest rise in oil prices and the fastest drop. And I think that's an anecdote, but that sort of shows where we've been moving from. There's been many phases already in just a few weeks where markets have bounced up and down a lot. Oil is currently around 100, and natural gas, which is the other key price and particularly important for Europe, is around 45 euros per megawatt hour. So that's oil is 50% higher than it was at the beginning of the year, and gas is around 40% higher. So it's a very significant increase, but from a lower base than, for instance, in 2022. And then if we look at stock markets, they tell, I think, a particularly relevant story when we compare across economies. And there we have Germany, across major economies, that's the stock market that has fallen the most and recovered the least since the conflict started. And this is consistent with what we know about the German economy and some of the key characteristics. First, we knew it was weaker in terms of growth momentum than its peers, even if there was some recovery and if there was some fiscal expansion. That fiscal expansion now is going to be harder with higher prices. Second, about the German economy, we know it's a very energy-intensive economy, so any shock to energy markets, and particularly fossil fuels, is harsher on Germany. And third, there is a combination of the two, which is the engines of growth for Germany are industries that are highly dependent on energy. So naturally, in the stock market in Germany has been one of the worst performing ones. And in contrast, within Europe, we have Spain, for instance, where the stock market has went down a little bit, but has fully recovered the levels of the beginning of the year, and overall suffered much less. Spain has a much more diversified economy, higher reliance on green and renewable energies, and it remains one of the best performing advanced economies and its stock market as well. The US stock market, which we definitely need to discuss as well, has been particularly optimistic since the ceasefire was announced. We've seen a very important recovery in stock prices, which implies that U.S. markets are somewhat more optimistic perhaps. Also that the macroeconomic conditions were stronger in the U.S. at the start of the conflict. Also that they're net exporters of energy, so therefore they're less affected by energy prices. But I'm not so certain about that optimism in stock markets in recent days. And indeed, if you look at sort of other key market, which is the government bonds, you see sort of a different story. It's sometimes common that those two markets, stocks and bonds, move in different directions, but looking at the 2-year government bond yields, which generally reflect a combination of inflation expectations and relatedly the expectations around where interest rates are going to go, central bank interest rates, you see that bond yields have increased quite a bit for all advanced economies. And those have not gone back to pre-conflict levels. In some cases, like in the UK, they rose by 50 basis points in just a couple days in mid-March, which is very meaningful. And they remain around 80 to 60 basis points higher than they were in February. And this tells us that markets, while there's some recovery in stocks, they're still quite concerned about the impact that the conflict is going to have on prices and on borrowing costs for countries, which means for the country's fiscal space as well.
Yeah. And the latest outlook for the euro area, which I know you work on, how are different countries being affected and how are policymakers responding so far?
Yeah, so by the time this is out, we should have the April update. So I can give you some of those numbers. But first, I think it's useful to take 2022 as a reference point. It was relatively similar shock in the terms that it was a conflict-driven supply-side shock to energy. But there's also important differences in terms of the outlook in the starting points. In 2022, we were in a high inflation, high growth momentum environment. Because of COVID, we were coming out of COVID, energies were rebounding, the euro area economy was almost starting to overheat. And in 2026, we're almost at the opposite starting point with low inflation, which was around target of 2%, and low growth, even if there was some rebounding going on. And my colleague Dino Panitsas has emphasized within this context something that is particularly relevant, which is that the labor market is both stronger in the sense that unemployment is historically low right now in the euro area, but wage growth has been cooling down for several months, which signals that there is not this pent-up demand, that there's not this strength in the European consumers that we had in 2022. So within this framework, we are naturally revising the outlook to decrease growth and increase inflation. As of mid-April, again, we have growth for the euro area around 1%, barely.
And that's from what at the beginning of the year?
Yeah, from 1.3 just in February. So it's a pretty significant revision, 30% lower, more or less. And with some countries having massive revisions. Germany and Italy were cutting pretty much by half the growth prospects for the year. And others like France and Spain, as we discussed before, more given their sort of energy sources composition, they're more resilient and we're cutting much less. And inflation, we're also revising quite significantly to 2.9 for 2026 on average, which would be quite farther from the target, which is 2%. This is sort of stagflationary, which is a nightmare for...
No, it's not the best scenario at all.
No, it's likely the worst for policymakers. In the sense that, particularly for central banks, if we think they have two objectives, which is low and stable inflation and a strong and sustainable growth, their inflation is being pulled up while growth is being pulled down. And that puts in conflict both objectives, because they would want higher interest rates to cool down inflation and maintain that low and stable inflation, but they would also want lower interest rates to boost growth. And of course, they cannot have both at the same time. So in terms of policy reaction, which was I think the second part of your question, we see that central banks are taking sort of a cautious approach right now, not suggesting that they're going to overreact to this shock. If you think about it, it's, as we said, it's a supply side disruption. Central banks cannot reopen the Strait of Hormuz. But they are signaling that if inflation displays some persistency, if there is what we call second round effects, a more broad-based inflation, they might start to tighten their policy rates, so increase policy rates. But most of the response, as it should be right now, is coming from the fiscal side. So this is mostly support to companies and consumers, and the approach most countries are taking is basically reducing taxes on gasoline and other key fuels. This has some limitations. Many European countries' fiscal space is quite constrained. Some, like Spain or Poland, have more fiscal space, more dynamic economy, so they can accept reducing those taxes without their fiscal bottom line being hurt that much. But others like France or Italy don't have that space. And I think here is important to say that these policy responses are not ideal. They are, even if they work in the short term and even if they offer some important relief to consumers, which are the ones that are the most affected, if these policies are sustained for too long, they create distortions as well. And these are very broad-based policies that target everyone, and in a sense they can be regressive. So they can actually end up not helping the people you're intending to help, which would be poor households with high energy consumptions. You might end up helping high income earners that don't depend so much on energy consumption. So I think now, as the conflict persists and we know that there's not going to be a swift resolution, and even if there is in the hostilities, the prices will remain elevated for at least a couple of months. The policies need to start changing to be more targeted. EU Commissioner, President Commission, Ursula von der Leyen said that they need to improve price stability and predictability without losing the important signals that prices give us. So there's going to be some calibration that needs to start happening soon, and that is going to be the trickier part for the policy response.
It's very delicate kind of line to walk. So when you think about through which economic channels are companies being impacted?
So in some ways, this is somewhat similar to COVID. This is again a pure supply side disruption, where it's not just a shock to supply where prices change, is sudden interruption of critical economic flows. And this, as we've said, is the 20% of oil and gas that used to go through the Strait of Hormuz. In March, actually, some numbers just came out. There were 10 million barrels less per day in the world. That's about 10% of global supply. So some of the supply was recovered, but still 10% was basically lost. The International Energy Agency expects oil demand to decrease this year for the first time since COVID. So this is all signaling that this is a particularly specific kind of supply shock that also has complicated resolution because of the geopolitics of it all, but also because it's affecting other critical inputs. It's been discussed that fertilizers, helium, also are a lot of them come from the Gulf, and those key economic flows are interrupted. And then the channels through which companies are going to be affected is not just through energy prices, but through more broad-based increases in input cost. And we can think of fertilizers, of course, impacting food prices. Actually, we have some research coming out of how long it takes to move from a shock that affects natural gas to fertilizer prices to food prices, and it's around 6 months. So we might be seeing this sort of lagged effects, and this, of course, is going to affect cost. And helium, I just want to mention because it's an interesting point and affects something we've also done some research on. Helium is a critical input for semiconductors, and this means that they will impact a supply limitation in helium will impact memory chip markets, which in turn affects electronics, so phones, laptops. And this was a market that was already strained, in which there was already a supply crunch because of the very high demand from AI. We wrote about this in the beginning of the year. So there is the complexity of this broad-based shock to input costs, and the fact that these are also intertwined. And actually, we've had a couple of events, and we've done some polls with companies, and a small survey we had in mid-March. While input cost is what is in everyone's mind, companies told us that they saw three key channels, and that was a deterioration of the macroeconomic conditions. So all we've been talking about also affects companies, most likely through borrowing costs. Second, the direct impact of energy costs, so input costs, but also direct, just your electricity bill. And third, the disruption of the supply chain. So not only these inputs, but the fact that insurance costs, transportation costs are going up everywhere. So on the aggregate, the channels, there's going to be many. There's going to be different impact for different companies. We are at the point where we are starting to recognize the cost impact. There is a later, as I was saying before, a second round effects, which is when this reaches consumers and how they react. And that's hard to tell. And there is a more problematic if this becomes a demand side problem as well. And buyers, consumers, but also firms start to notice an impact on their purchasing power and start being incapable of absorbing the increased prices, that's when growth, and again, we've already downgraded growth, but that's when it
goes
can become
even further.
Exactly, can become a real problem.
Crikey. And so how do you see companies responding to these shocks? I know you're talking to a lot of executives every week. What are you sensing?
Yeah, so we even had some data points again from mid-March and some more recent. So in mid-March, I think it's interesting because it also tells a story about the conflict itself. What they were telling us is that they were focusing on strengthening their supply chains, on monitoring, on updating their contingency plans. So it's sort of a very tactical response to what's going on and sort of trying to stay up to date.
Yeah.
In April, now in more recent times, we've started to ask about costs, right? Because as we know, they're starting to materialize. And here we got a pretty surprising number, which is that in a survey we did, 60% of respondents expect to pass some or most costs to consumers. And responses were balanced. We asked them if it was some or most. It was 30% some cost, 30% of respondents said most costs will be passed on. And this can mean several things, but mainly either that European companies' margins are already quite
squeezed.
Exactly, stressed or squeezed, and that there's limited room for them to absorb more cost, or that they think that consumers can still absorb, and the labor market is, as I was saying, wage growth is not strong, but the labor market is relatively strong, and they can assume some of that cost. Probably in most cases both are true, and we know that there's competitiveness issue for European companies. But there is a delicate balance on how much companies can pass to consumers. And again, I think the concern here is if companies' margins compress excessively, where they need to start changing production, or consumers' purchasing power diminishes significantly, that's where we get into a new scenario where recession fears start.
Yeah.
We're not there yet, fortunately. But what we are hearing from companies of these tactical adjustments are not, particularly on the cost side, are not particularly optimistic in the near term.
How substantial do you think the impact will be? And I'd really like your kind of take on, we've talked about European economies, but the impact on Asian economies and the less mature economies as well.
Yeah, I think that's where the big concern is. I think is even if the European numbers are going to look pretty bad with growth around 1% or below 1%, there is some resilient, there is some lessons learned from 2022 in terms of stockpiling, in terms of how policymakers are equipped to support consumers. And I think the European market, in a sense, it's more prepared, particularly for emerging economies in Southeast Asia that have even higher dependencies on Gulf countries than Europe has. That's where the sharpest price increases are going to happen. We've already seen rationing in some countries, which I think that's a clear sign of them feeling the impact much faster than Europe. And then there is, I think, of course, the Gulf countries, and that's where the massive impact is being felt. And in terms of how substantial it is, it's hard to tell, but the concerning thing is that we know it will be prolonged.
Yeah.
And here we have an example, which is the Suez Canal, where they were attacked by the Houthis in 2023, and flows never recovered. They're still 50% lower today than they were in 2023. And that's even after sort of the conflict dissipated and attacks became very sparse. What this tells us is that sort of the concerns that transportation, insurers, companies have won't go away. So we know that this is going to be multiple months that it's going to take to resolve. And their emerging market economies, particularly those that are net energy importers, that don't have the fiscal space that some European countries have and don't have the structural capabilities to stockpile that Europe has had, are the ones that are going to suffer the most. And again, these are concentrated in Southeast Asia, but there are others we can think of, like Argentina is going through a massive economic recovery on the side of inflation, but also downturn. and others like large economies like Mexico, which have suffered some of the trade turmoil, that this is sort of a shock on top of other shocks. So the compounding effect for emerging markets is, I think, particularly concerning.
And then in the US, obviously, there's lots of reports about the price of gas at the gas station has gone up, to almost 20%. But what else in terms of the substantial impact?
Yeah, in the US, I think there is going to be quite some concerns around the fiscal stance in the next cycle of renegotiating the debt ceiling. And all of this puts further pressure on an economy that's growing still very strongly, that still has a strong labor market, but that has inflation over target. I think that's also an important difference compared to Europe, whereas in Europe it remains around 2%. March reading was 2.5, but in the US is much higher.
Yeah.
And there is a lot of debate about whether the tariff pass-through is going to be seen this year. So again, for the US, it's also sort of a shock on top of a shock, particularly on the inflation side. And there, if inflation remains above target, if we see core inflation to increase, that's where borrowing costs might increase, where the Fed is going to be in a very tricky situation, potentially forced to increase interest rates, and that interacting with the relatively weak fiscal stance from like very sustained high fiscal deficits might put the country in, even if there is still dynamism and still growth, there might be pockets of vulnerability that are particularly concerning.
Yeah. We're going to take a short break and be right back with more of my conversation with Alejandro.
What does the future of work mean for your employees? How will your company navigate the future of AI? Will there be a global recession? At the Conference Board, our experts translate the latest research and economic analysis into insights and real-time problem solving for your organization. Membership at the Conference Board provides your team with an assortment of knowledge from economics, marketing and communications, governance and sustainability, public policy, and human capital. As a member, you'll have access to our center experts, member-exclusive events, data and benchmarking tools, and peer sharing that will help you understand the present and shape the future. Consider becoming a Conference Board member today by visiting www.conference-board.org.
Welcome back to C-Suite Perspectives. I'm your host, Sara Murray, Managing Director International at the Conference Board, and I'm joined by Alejandro Fiorito, economist at the Conference Board Europe. So just continuing the conversation, what do you think are the main structural implications of the conflict for Europe in terms of growth, investment and energy sourcing?
So even if the most optimistic predictions materialize and we get oil and natural gas prices back to normal, which means for oil in the range of $60 to $70 per barrel, the threat of a disruption, as we were talking, will remain. Companies might not go back to normal, particularly sort of transportation, shipping companies, I mean. And these, for Europe, will mean another realization that energy dependencies need to be managed.
Yeah.
And that they need to be managed and they're here to stay. So in terms of policy making and structural decisions, does not really change the priorities. It only further stresses the urgency across some key areas, which here in Brussels, I know like sort of the urgency talk gets a little overwhelming and even counterproductive because everything is urgent. But it gives us also time to reassess those priorities and sort of perhaps try to narrow down even more what is absolutely necessary. And there are several areas. The most obvious one is the energy matrix, and the need to diversify away from fossil fuels, rely more on renewables, not only because climate change matters, but also because this is the one type of energy that Europe can produce pretty much on its own at scale. And this also means improving the electrical grid integration, which has been a conversation that's been going on for many years. across EU countries. And then that sort of integration moves to another very recurrent discussion, which is a more increased integration and a stronger single market. And this is important so the domestic market is more dynamic. We were talking before about why the US is more resilient. These are the two key factors, right? A better or a more efficient energy matrix or less energy dependence and a more dynamic domestic market. And related to this, there's the Capital Markets Union that still needs to be completed. And here there might be some interesting structural movements on the savings front because European consumers are very cautious, more than the US, again, in particular. So in crises like this, we see precautionary savings that increase a lot.
Yeah,
that's not necessarily bad. It's just a choice. But there is a number that's not discussed enough, I think, which is that saving rates in Europe are in the double digits, on average around 14%, I think. In the US, that number is 4%.
Wow.
So that means that more money is being put into the US economy. And that would not be a problem if those savings in Europe were being invested, were being channeled through financial markets to any kind of productive investment. But what we see is that a large amount, I think more than half of it, just stays on deposits in bank accounts, right? So the mobilization of these savings is very important. It becomes even more important when there is this sort of precautionary increase in savings. And I think here the key is not so much, it is on the Capital Markets Union, it is in the integration, but it's also on finding those productive investments, right? And there is a very important part that actually this one might be a little missed in this whole turmoil, a priority that we need to emphasize, which is focus on productivity and not necessarily on competitiveness, or rather get to competitiveness through productivity improvements. Don't get to competitiveness, and this is external competitiveness, so you can think about exporters, through giving subsidies to companies that are not efficient, but try to give support, market-based support, temporary support, targeted support to companies that have the possibility to be more efficient and be more productive. And this has very important implications, particularly because the fiscal space is limited at a time when we're going to see support to sort of companies. And you need to do that in a healthy way, where you're encouraging innovation, where you're promoting productivity. So I think this distinction in the middle of a crisis might get lost, and we might focus on not losing productivity, losing competitiveness, when we need to be focusing on strengthening productivity.
Yeah.
And just if I can give you one number there, we do this exercise called the Global Economic Outlook every year, which the conference board with the teams in the US and Asia, and we project growth for the next 15 years. And across major economies, or economic powers, the euro area actually has a negative contribution to growth from total factor productivity.
And why is this? Why is there such a difference between Europe and America, for example?
Well, there are multiple explanations, and this is where everything is a little bit intertwined and related. Big part of it is the inefficiency in energy. Big part of it is the internal barriers. And there are also cultural issues around the savings and the more precautionary nature of the European system. There's also technology is the big sort of driver of this difference, and how you create an ecosystem that adopts technology faster. And there are things that can be done, but there's also a lot of sort of first mover advantages, right? That the US has and has had for many years. So there is this big discussion about how Europe needs to catch up in technological terms, and that is where I think more effort should be done and more resources should be getting to really increase productivity. And maybe it's not so much about catching up, but it's about finding complementarities with high growth partners in the US, but also elsewhere on different industries, and realizing what's the comparative advantage that Europe can find on that. But yeah, the numbers are quite striking. Is where they're mildly negative. They're not. It's not like productivity is a headwind for Europe, but it's basically zero contribution to growth in and not even the US. In countries like Canada or Australia, you see total factor productivity contributing between 0.5 and 1%
Wow.
of growth per year. So that's quite meaningful if we think about current growth rates for Europe.
And when you think about the broader implications for global financial markets, what are they over the medium term?
Yeah, here I think the hottest topic and the most controversial is the international role of the dollar.
Yeah.
And there is a big discussion about petrodollars and what they mean and what role they have played. And sort of here we discuss the exorbitant privilege that the US has, which means that the US, by providing the main international currency, which is the dollar, receives some benefits from doing that. This is basically the ability to borrow at lower cost than other equivalent countries. And the way oil trade is done sort of supports this, right? Oil is paid in dollars, therefore countries that sell oil receive US currency, and then, of course, to not lose purchasing power, they invest that US currency, and one thing in which they invest is in US debt, right? So that's where there is a lot of demand for US debt, and the US sort of gets what we call the convenience yield. So sort of some sort of premium because people want your debt so much. And there is discussion about oil markets moving away from the dollar, about Iran selling oil denominated in renminbi or Bitcoin even. I don't think this is that meaningful. It's still pretty anecdotal, but there are some things that we need to pay attention. There are some structural changes on global financial markets. One is that China, the international promotion of the renminbi is just natural as the Chinese economy grows. The US economy is 25% of global GDP, and its currency is 50% of international reserves. So there is sort of an imbalance there. And there's also the part of geoeconomic turmoil on top of the current war in Iran, tariffs, trade disruptions, all that discussion. But I think it remains highly unlikely that the world is going to move away from the dollar, in part because the US...
There's no alternative.
Exactly.
Yeah.
I was going to say part because the US remains so strong, but mainly because of what you just said. The alternatives are just not there. There's a lot of inertia in these markets, and when you look at this, Europe could be an alternative, and it has some of the key elements you need for a reserve currency, including a very independent central bank, good institutions, a strong currency, a currency that is tradable, something that China does not have. When for large transactions, it's really hard to access a lot of yuan. It's not hard to access a lot of euros. But the problem goes back to the debt and the fact that the US dollar is so popular because US treasuries are so popular, and there is a reinforcing dynamic there. This is sort of, again, the sort of a first mover advantage in a sense. So holding euros is relatively less attractive because, to put it simply, there is not that many things to buy with them. There's not that much high quality euro denominated debt. Emerging markets don't issue euro bonds at scale, at least. So that's where we go back to deeper market integration, expansion of even common debt, which is a very controversial topic in Europe, would be things that could move Europe forward, the euro forward, but they're not there yet. And as I said before, the Chinese renminbi is not a freely traded currency. It's a currency that is really affected by policy choices from China, a lot of them around competitiveness. So you do not want to be holding a currency you think might depreciate for reasons that are not purely market driven, to put it that way. What is meaningful is that even there's no alternatives right now, both the ECB and Chinese authorities are making a push. And I think they're making a push because they see an opportunity to a large extent, and because they see the benefits in having a larger role. I wouldn't say displacing the dollar, because again, I think that seems too unrealistic, but of having being more proactive, which from the European side, I think it's very, very welcome. I think there is opportunity to do more business in euros with Gulf countries in the future that might want to diversify, with any country that wants to diversify, which is nothing per se against the US dollar, but it's more of a sort of
diversification,
a strategy that just companies will also do, right?
But what time frame do you think that will take?
I think there can be meaningful movements in the next few years. There is a very meaningful development that's not been discussed that much, which is that the European Central Bank has basically established what we call repo lines, which are liquidity lines to other central banks that can borrow euros from the ECB, giving collateral. That collateral is euro debt, mainly. Can be other things, but mainly you can think of euro debt. So central banks that you can think of emerging countries, but also other advanced economies that don't have the euro, the Swiss central bank, could borrow euros. And many of them already can without collateral through other types of agreements. But what this does is it lowers the risk of holding euro assets, right? And in a sense, I think we might start seeing some movements in the next few years, in part because of policy choices done from Europe that are very positive. Because just get a little bit wonky here, but what the repo lines do is that when a country needs liquidity, they know they can access euro liquidity. So instead, in times of stress, we sometimes see what we call flight to safety. And the flight to safety is usually buying US treasuries, because they're highly liquid, because you can invest in them and they're safe and trade them. That might mean for some countries selling actually European debt, which is bad for European debt markets. When you give access to a repo line, to a liquidity coming from the central bank that is safe, in times of stress, what you might actually get is that countries want to hold European debt, so they know they have access to that liquidity. And not only they don't sell it to get access to other currencies or to increase their liquidity, but the demand might increase. So I think we might start seeing some meaningful changes. It's hard to tell at what scale. There is here a little bit of competition with China doing something similar with swap lines and lending a lot in emerging markets. So I think we will see some very meaningful changes in the next few years, something structural where the US dollar moves from being 50% of international reserves to 40 or even lower than that, is something that would take, I think, much longer.
But 10 years ago, was it 50% or higher?
10 years ago, it was around 60.
So it's good. So
in the early 2000s, it was around 70, but in the 90s, it was 58.
Okay.
So I think as long as it remains above 50, I think there's a lot of noise around, it's gone down from 70 to 56 or 58, I think it's now. But it's important to remember that in the 90s, it was at similar levels. So I think the breaking point is lower, and that's where it's hard to go down. Relative prices become distorted, and frictions come up, and markets stop working well. There's market inefficiency. And the implication for companies of all this is that they struggle more and more to predict, anticipate prices, anticipate consumer behavior, or really know what the macro conditions are going to be, which all is bad for long-term planning and investment planning. There is this anecdote going back to the oil markets of oil producers in Texas, when this is broadly paraphrasing a quote from one of them, said, we would be expecting to invest more with high oil prices. But because we don't know if in 1 year oil prices are going to be 150 or 60, we don't know what to do. And what that anecdote tells you is that the market is not able to adjust when there is high uncertainty, because what would be tail events, sort of extreme, so oil being extremely low or extremely high, are more probable, and your baseline therefore is less likely. It's harder for you to make a decision. So I think what we're seeing is more difficulty to make decisions around a baseline. We're not yet seeing sharp changes, I think, because to some extent the natural thing to do when there's noise is to keep course, and that's, I think, what companies are saying, making tactical adjustments, but not strategic ones. We, in the latest CEO confidence survey last year, we saw a continuation of dynamic from European companies or European-based CEOs of increasing investment in the US.
Outside of Europe.
And sort of, yes, and being either maintaining investment in Europe or decreasing a little bit. That is a trend that is continuing. At some point that might change, but with this very, very high uncertainty, I think we are not yet in a position to say this is how companies are reshaping. We have the next edition of the CEO confidence survey coming up in more or less a month. Yeah. So we will be asking about that.
Interesting to see the results.
Perhaps they have some, perhaps they start to indicate that there are some long-term changes, but how they're thinking, it's quite hard for me to tell and for them to say. I think for European, to make sort of a final point for European companies, I think there is something interesting happening where is same as countries are realizing the importance of domestic priorities, or what we discuss about economic security, strategic autonomy. That means investing more domestically. So that is very hot discussion topic here in Europe. And that puts European companies in an interesting position, because on the one hand, you're going to have the fiscal support that we've been talking from fiscal expansion in Germany, all the defense spending that's going on that might want to make you look inward a little bit more. And at the same time, Europe, I think, has sent a very positive signal with trade agreements, with an openness to maintain a rules-based system and to maintain, to remain open for business, pretty much. And I think European companies can sort of play on that duality of, we are looking at Europe for critical investment, for strategic autonomy investments, and we know we're going to get some support there that's important, but we remain global businesses and we remain committed with free trade and other partners. And I think that is an interesting position to be, even if there's high uncertainty around all potential outcomes.
Yeah, indeed. Alejandro, I could talk to you for hours and hours. Thank you so much for this. But our time is up, and I very much look forward to welcoming you back in the not too distant future, because as you said at the beginning, this is kind of changing by the hour. But it's just been really, really helpful to the listeners to get your perspective on this. So just thank you.
Thank you very much for having me.
And thanks to all of you for listening to C-Suite Perspectives. I'm Sara Murray, and this series has been brought to you by the Conference Board.
You have been listening to C-Suite Perspectives, a podcast by the Conference Board.